morning once again. My name is Per Wisén. I work at the Institute for Financial Research, SIFR, and together with SNS we produce this seminar series that we called Finanspanelen, finance panel or something in English. And the idea is that we have somebody, I will introduce our speaker today, introducing a topic, and then we have half an hour or so for debate from you. You come here to debate and discuss and ask questions rather than just sit and listen all the time. And today we are very proud and happy to have Professor Franklin Allen as our guest. You've been here before a couple of years ago, maybe on the topic of China that time as well, I think it was. Franklin Allen is at the Imperial College in London and is executive director at the Brevan Howard Institute in London. He's a frequent visitor to Stockholm in the scientific advisory board, if that's the name, at the Riksbank. Not anymore. Okay. Has been at the advisory board. And today we will talk about China. And Franklin will introduce the topic. We have 45 minutes or so for the presentation, and after that we can discuss the paper and the presentation and also broader issues on the Chinese economy. So Franklin Allen, we are very happy to have you here. Please, the floor is yours.
Thank you, Per. It's always a great pleasure to come back to Stockholm and to SNS. I'm going to talk about today the Chinese stock market, and obviously that's been in the news a great deal over the summer. This is a paper we've been working on for some time, and we're continuing to work on. There are lots of things that we've done, but there's still many to do. And I think it's important to take a long-term view. And I think most people don't have a good sense of actually how the Chinese stock market has performed over its existence. This is a joint work with my frequent co-author, former student QJ, and two other of his colleagues at the Shanghai Advanced Institute of Finance. That's an interesting institution. It is part of Shanghai's push to become a global financial center to compete with New York and London. And it's part of Shanghai Jiao Tong University, but the idea is to have a world-class institute there and come up with ideas to help the Chinese financial system. And this isn't formally part of that, but I hopefully it will have some input to that. Now, a starting point is the fact that China has performed incredibly well in terms of economic growth. So if you go back 30 years, its GDP was a small fraction of what the GDP of the US was. But last year, if you work in PPP terms, purchasing power parity, so you adjust for price differences, it actually overtook the US and became the largest economy in the world. I think even more interesting than that is the notion that if these growth rates continue, and even if it slows down from the current 7%, goes to maybe 6 or 5, if we go forward and you think the US will grow at 2.5%, 3%, in 20 years' time, in 2035, it'll be twice the size of the US. And that's a world that's a very different world from today, because it will be the dominant economic power. It will be roughly the same as the EU and the US together. So it really is a miracle in my view. They've lifted hundreds of millions of people out of poverty. Many people there have middle-class lifestyles. It's the largest car market in the world. A great success story. There's still much more to do, though, obviously. Now, the stock market was founded in 1990. There are 2 exchanges within mainland China, Shanghai and Shenzhen. Shanghai has more traditional kinds of companies, raw materials, banks, those kinds of companies. Shenzhen is a little bit smaller and more dynamic companies, as we'll see. Most of the companies are former state-owned enterprises or still part of state-owned enterprises, as we'll see. The Hong Kong market has changed fairly significantly. Over 60% of listed companies on the Hong Kong exchange are now actually located in mainland China. So we're going to treat that as part of the Chinese stock market, as you'll see. If we look at market capitalization, and if you aggregate Shanghai, Hong Kong, and Shenzhen, you get about $9.2 billion. And that puts it at number 2. It's significantly more than Japan and Europe now. So these are important markets. One of the big issues facing the MSCI is whether to include China in its index. And that there was some talk of that. It didn't happen, but I think probably within the next few years it will happen, and that'll mean that it's much more of a mainstream market. As we'll see, though, there are a number of issues, which is what the paper is really about. Now, this is buy and hold returns of a number of countries. The black line is China. Now, as I was founded at the end of 1990, in 1991 there are only a few companies. So we actually start this in 1992. And what we've done here is to take in each country 1 unit of currency, and then we've looked at the real return. So we've used the domestic inflation and looked at what a domestic investor within the country would have received, including dividends. Now, one important point is that they had a big reform in 2006-2007, where the government, which in most companies that were listed owned the majority of shares, they made them tradable. So before that, they were not tradable. They were held, but the government couldn't potentially sell them. Now, when they did the reform, what they did was to negotiate firm by firm with the outside shareholders, and they allocated an increased number of shares in the company to those private holders. And roughly speaking, the average amount that they got was a transfer of about 30%. So there's like a stock dividend of 30% built into these numbers. Now, I think what we would argue, though, is that that's not a good measure of the representative performance of the firm, because you're just having a one-off allocation. So these numbers, because the indices include that, but we'll show you numbers later on which don't. And a large part of the performance over these 20 years has been because of that, as we'll see. Now, this goes to the middle of 2014. That's when the bubble had already begun, and so you'll see later on that that affects the figures. So if you go back, 3 months, China had done much better. Now it's back. The last time I looked, about Shanghai Composite's about 3,000. It's prior to the bubble, it was trading the 2,000, 2,500 range for a long time, and we'll talk more about this at the end. But my guess is that's probably where it'll go back to once the Chinese government's purchasing initiatives are ramped down. What you can see here, though, is that they haven't done very well. This is a miracle economy, but it's not a miracle stock market. And if you compare it with everywhere except Japan, it just hasn't done very well. Now, if you look at the star performer is in fact Brazil. Brazil has done astonishingly well over this period. US, of course, has done well, and India, as we'll see, hasn't done well during this particular period, but it's done somewhat better in the last 10 years, as we'll see. But that's the basic puzzle that we're interested in. Now, inflation in China in the early 1990s was extremely high. So as you can see, it was over 20% for quite a while. And so a large part of the poor real performance of the stock market is due to that inflationary period. Now, the other thing that's important is that they introduced a lot of reforms to the market at the end of the 1990s. And the number of companies by the end of the 1990s had grown to a reasonable number, about 1,500. So what we do in this paper is focus on the period since 2000. Now, if you look from 1992, GDP's gone up about 8.5, 9 times. So tremendous performance. Even since 2000, it's if we set 2000 at 1, Chinese GDP is now at 3.6, 3.7. So it's gone up about 270%, which again is this part of this phenomenal performance. If you look at India, India has also been successful, not quite as successful as China, but still gone up 150%. Most of the other countries, if you look at the growth over 15 years, it's not that much. So even Brazil, which has actually had a fairly successful time until the last 2 or 3 years, it hasn't grown that much, maybe 50%. Of course, US and Japan have not grown in aggregate that much. So China's been successful in terms of growth through all these periods. If we look at buy and hold returns since 2000, you can see that at least till the end of 2014, China actually had the worst performing stock market in terms of buy and hold return. And that's what got us interested in this, because it's a real paradox. Because if you think about many popular press articles, for example, the usual notion is if you want to get good stock performance, you should go and invest in high growth countries. And so China, many people think of as being a good destination for investment precisely for that reason, that it should be a good performance. But the interesting thing is it hasn't been. It's actually been, as you can see, at least for this period, the worst in the world. And actually did worse than Japan, and not nearly as well as India and Brazil, which have done much better here. So that's the first real puzzle, which is how can you have the worst performing stock market in the best performing economy? What's going on there? Now, just to give you a sense of quite how bad this performance is, what we've done here is to compare the stock market performance, which is the black line, against what happens if you put money in the bank. Now, the red line is demand deposits, the blue is 1-year deposits, and the black is 5-year deposits. And you can see that in real terms from 2000 to 2014, in the stock market, you just got just under 80% of what you put in real terms. You would have been better off actually in demand deposits, or checking accounts, or whatever they're called in various countries. 1-year deposits broke even, roughly speaking, in real terms, and 5-year deposits gave you 20%, just over 20% in a 15-year period. So it's a very small. Now, of course, the other big asset class is real estate, and that's been a roller coaster ride too. It's done somewhat better, particularly in Shanghai and Beijing, in real terms, despite the fact that prices have come down in recent years. They're still a big gain on that over this kind of period. Now, if you look at China as a whole, though, that's not the case. If you aggregate across the countries, real estate hasn't performed particularly well. It's probably done better than these, but as you can see, Chinese people don't have many good assets to invest in. And I think one of the reasons that we see so many Chinese students around the world in many universities in the US, in London, and in much of Europe, is because that human capital is actually a much better investment than these financial assets. Now, one issue is how have the different exchanges performed. And what you can see here is that the black line, which is Shanghai, is the worst performer. In Shanghai, you wouldn't have got even 60% back over this period that we're looking at. In Shenzhen, you would have done somewhat better. As I said, those are somewhat younger and more dynamic companies. Hong Kong, you would have done somewhat better. You would even have made more than that you'd put in, but still not very good when you think of this dramatic economic performance. Now, one question that this issue of the poor performance of the stock market in a fast-growing economy is, well, what's the correlation between growth in the long term and stock markets? And what we've done here is to look at 5-year rolling averages. So we look from T to T plus 4 for the stock market, and we look at T plus 1 to T plus 5 for the real growth rate. And then what we do is look at the correlation. So the question is, do stock markets, if you've got in a growing economy, does the stock market go up? And what you can see here is that you look at developed countries like the US, Japan, Germany, or France, or the UK, that correlation is pretty high. So indeed, there is this relationship. And in some emerging economies, there is too. So Brazil has that feature, and Russia, and many of these other economies. But the interesting things that in China and India, this correlation is extremely low. So these companies that are listed are not representative of the economy as a whole. And that's the first solution to this puzzle. They are, as we'll see, different in many ways. And a large part of that is because the listing process in China, which I'll talk a lot more about, is very different than the listing process in the West. In particular, it was a political process, and it still is. The reforms haven't actually yet gone through. And the notion was you needed to be politically connected, and as we'll see, you needed to satisfy fairly stringent conditions which are quite different than kinds of conditions in the West. And one of the big reforms that they want to put in place at the CSRC, the Chinese Securities Regulatory Commission, is to change that and move towards a more traditional Western kind of system. Now, the next set of slides compares the different sectors of the economy. And the way we think about this is there are state-owned enterprises. They used to be most of the economy, but over time they've become increasingly smaller part. Then we've got the listed companies, and then within the SOEs, or within the listed companies, we've got SOEs and non-SOEs, and then we've got unlisted non-SOE companies. Now, here we're measuring net income. So this is accounting data, net income data. Because many of the SOEs, for example, aren't listed, so you can't use market cap. You have to use something like this. And you can see from 2000, the proportion of this SOEs in net income has gone from around a half to around a fifth. So it's fallen quite significantly. Among listed, if you look at listed relative to all, that's also shrunk. That's gone from about a third to about a fifth. And if you look at listed SOEs to listed all, that's again gone down. It's gone from about 90 to 3/4. So it's still the case, though, that SOEs are dominant within the listed companies. And that's the problem. That's the undynamic part of the economy. You can see here, if you look at unlisted firms, which are non-SOEs, that's the growth engine of the Chinese economy. And they've gone from about 2/3 up to 90%. And it's not just in this period. If you look over the last 30 years, that's the big story. That's what QJ and I have worked on for a long time. That's the successful part. If you look at net income growth, you get a somewhat similar story. So if you look on average what net income has been growing, you can see it's about 23%. The SOEs are significantly below that, and the non-SOEs are significantly above that. Listed companies are about like SOEs, which is not surprising since most of them are like that. The unlisted are doing better again. And similarly, listed SOEs are about the same as other SOEs. Listed non-SOEs are doing much better, and unlisted non-SOEs are doing much better. What we've done here is to look at the contemporaneous correlation between net income growth and GDP growth. And what you can see is that, again, there's this stark difference. The listed companies aren't very correlated with GDP growth. The unlisted are. So that's the first big problem with the stock market. It's a very special set of underperforming companies. And this does the same thing. Here we've looked at listed and matching unlisted firms. So for each listed firm, we've taken a firm that's unlisted in the same industry, which has about the same size of assets. Has to be within 80 to 120%. The light blue is the unlisted, the black is the listed. You can see the unlisted is just doing much better. And we'll come back to that again. That's a big part of the problem here. So that's the first part of the question, or the answer to the question, what's going on, this disconnect between listed companies and the economy as a whole. What we did was to dig a little bit deeper than that, though, and what we argue is that there are three other major problems with firms that are listed. The first is the IPO process, and I'll talk more about that in a minute. There are also problems with delisting. In most countries, if you do poorly and you have negative earnings, you get delisted fairly quickly. In China, that doesn't happen. It's very rare to have delisting there. And I'll talk more about that in a minute. Now, the other thing which is striking for these listed companies is that they invest a huge amount. Unfortunately, the returns on that investment is very low. And this is a big part of the spillover into the global economy at the moment. They're building up huge capacity in industries like steel and oil, raw materials, all those kinds of things. Prices are falling because they have this huge overcapacity, and that's having this big spillover on things like inflation and so on globally. Now, what we'll argue is that that's inefficient, but also we'll argue that there is apparently tunneling. In other words, particularly among the SOE sector, they take the listed entity, they raise money, but then they do related party transactions at prices which don't represent the true value and take money out. And I think that all three of these are problems that need to be fixed if China's stock market is to start growing and performing in the way that one would expect it to in such a dynamic economy. Now, let me talk a little bit about the listing process, first of all. As I said, it's very political. At the beginning, there were regional quotas, the usual kinds of political things. You needed to be connected. The other key thing is that you needed to have positive returns for 2 or 3 years in order to get listed. And the problem is that that is actually a big constraint, particularly for the kinds of dynamic companies that we'd like to see listed. So in many countries, the companies that are actually listed are in their growth phase, they're investing a lot, they very often have negative earnings. So this constraint is a very significant one. Now, what you can see is that what happens if this is the listing date, and if you look at return on assets, you can see there's this big run up to get returns up to have these 2 or 3 years of positive earnings. Now, once they get listed, it falls off a cliff, and then it continues to go down. And that's the problem. You can see something similar happens in other countries, in Brazil and a little bit in India, but nothing like the way it happens in China. And we've cut this various ways. I don't have the slides in this deck, but if you look, the cash goes up and then it goes down as they start investing it, but they're not investing it productively, and we'll see various other measures of that. So that's the first issue. Now, we have some more of these tables in the paper, but there's 2 kinds of manipulation going on. The first is it's accounting manipulation, so they do the usual kinds of tricks with accruals and so on. But in addition, it seems they do real kinds of things to really exhaust growth opportunities early and so on, and have real inefficiencies in the way that they perform. This is another take on this. What we've done here is compare with listed overseas. And the problem, the interesting problem with the listing process is that the famous companies like Alibaba and Baidu and Tencent, they're ADRs. They're listed in the US or in London. And I think that also reveals a lot about how poor the listing process is in terms of choosing companies, good companies. And you can see they don't have this effect on return on assets when they're listed. If you look at matched firms in the same industry, you don't see that. So this is purely a result of the listing process itself. If we look at things by cohorts, what we've done here, the black line is all listed firms, and we've done 4 cohorts according to when they were listed. And you can see this is true in all these time periods. So this isn't a particular cohort effect. It's generally there for all firms. So let me just finish off on the listing. This is a problem. The CSRC realize it's a problem. They're going to reform it. Hopefully they will then be able to get a transition from the poor firms to the good firms, and then people can start making returns, and the pension funds and so on, which China's going to desperately need as it goes through the demographic process as a result of the one-child policy, they're hopefully going to get a decent return on their stocks. Now, delisting is very rare in China. About 10 firms out of roughly 2,000 a year get delisted. Now, there are a number of reasons for that. The first is that Chinese people have a very debt mentality, even for equity. So we had lunch at the CSRC, and they were explaining that if they delist a company, then they get huge numbers of people writing in and complaining, saying, you know, we gave you 100 RMB for our shares, and now it's worthless. So we've been cheated, and this is a terrible thing, and you know that you as a government should need to do something. So to minimize that kind of problem, they're very reluctant to delist. That's the first thing. The second thing is, because the IPO process is so complicated, these shells of firms which have no good economic activities themselves are actually valuable, because if you want to have a listed entity, what you need to do is to take over one of these firms and fold your firm into it. So a number of firms have done that. Now, in terms of stock market performance, this is a problem, because these firms which are negatively performing stay in the index. Whereas in other countries they would have gone out, here in China they stay in. Now, what we've done here, and again there are several cuts in the paper, this is just one of them, but they all confirm the same story. So what happens is, in China, if you have 2 years of negative earnings, you go on what's known as special treatment. So since so few firms are actually delisted, what we use as our comparison group is this short or special treatment group. And that's this black group. Some firms get off special treatment and recover, others are just there permanently, effectively. And what we've done is compare them with US delisted firms where the delisting's due to a liquidation or being dropped. Clearly in the US, many firms drop out because of mergers and acquisitions and because of going private. Those firms perform obviously much differently than ones that are just dropped. But what you can see is this Chinese special treatment basically perform the same as the American delisted that are being liquidated or dropped. But as I say, they keep going. Here, this is the point of delisting, but these black lines keep going within the stock market index, and that's a big part of the problem too. Now, as I say, though, the other huge problem is investment efficiency. So here what we've done is to look at capital expenditure over lagged assets. And what you can see is that China just invests much more than any other country, and that includes the other BRIC economies of Brazil and India, which have again these tremendous growth stories. But China is way above that. It's investing about 8% or something on average of its asset values. Now, what's that generating? Well, in terms of net cash flow over total assets, it's the lowest, roughly speaking, not literally year by year, but on average it's towards the bottom. And that's the basic problem with the stock market and now with the economy. They're not investing efficiently. And as part of this drive to keep growth at 7%, that's part of the issue. And what's happening is, in many industries we have this huge overcapacity, as I mentioned earlier. Now, the other issue is, what about tunneling? So a lot of people view the Chinese stock market as this place where money can be tunneled out, and there are a number of studies of that. Since we're dealing with the whole stock market, it's difficult to do a very detailed forensic study to figure out exactly how much money is being taken out. But what we've done here is to do regressions of the relationship between related party transactions and net cash flows. And these related party transactions are ones where you buy some equipment or some other asset or input from a company within the same group as yours, and there's a price, but that price isn't necessarily an economic price. So if you pay a lot for investment equipment, for example, then you're effectively taking money out of the listed entity into the unlisted one. Now, what you can see here is that the higher are related party transactions, the lower is net cash flow. And that's an indication that tunneling is going on. And you can see that it seems to be happening in these companies. And that's the other big part. And I think one of the big issues is breaking out this poor investment performance versus tunneling more generally, and getting a much better understanding of that. If we look at valuation metrics, just to finish off, it's very interesting. If you go back to 2000, price-earnings ratios in China were extremely high. And over time, there was this bubble in 2006, 2007 when we had these reforms. But over time, it's dropped from around 35 to around 20. And I think that's part of this learning, that actually the companies that are listed ones don't have the growth story. And the same with market to book. So it's varied a lot, but they're not bad valuation metrics. So let me conclude and then turn it over to the discussion. So there is this big disconnect between economic growth and stock market performance. I think that's not widely known. People are focused on what's happened over the last few months, which has been this roller coaster ride. But in fact, it's been a very poor performance for many, many years. We've looked at why. The first problem is it's not representative of the economy as a whole, as I said, but then there are these other important issues of IPOs, delisting, and investment efficiency. There needs to be reforms, technical reforms in terms of the listing process, the delisting process. The CSRC knows that. It's on top of that. It takes time to do those kinds of things. The other major thing is to improve corporate governance, and this is really, the Chinese government needs to decide exactly how much it wants to trust markets versus trusting the traditional planning kind of approach. At the moment, they're into kind of planning mode because they want to keep the growth at 7%, but at some point they need to turn it over to the private sector, and the main impetus for that, I think, will be the opening up of the financial sector. They're under WTO, they're committed to doing that. Once they open the capital account, there will be this threat of competition with foreign stock markets and investments, and that will force changes in corporate governance and improvements in investments. So that is underway. The problem is that the anti-corruption campaign has been the focus of everybody for the last 2 or 3 years, and the Shanghai Free Trade Zone, which was designed to pilot many of these reforms that are necessary, has kind of been on hold. It's been there for 2 years, but nothing much is happening, and that's designed to test out how capital market integration and so on will work. Let me just finish off with a few comments on what happened over the summer. If you look at the fundamentals, they didn't change. None of these things about net cash flows, earnings, none of those things really drove the Chinese stock market. My own take on what happened is the real estate, in particular in Beijing and Shanghai, but other large cities too, went down in price because the government put in place what we would call macroprudential, so they put limits on loan-to-value ratios and things like that. That was reasonably successful in bringing down real estate prices, so then a lot of money flowed into the stock market, but then people realized that these valuations simply weren't sustainable. It started falling off a cliff, and we had day after day of massive falls. Then the government decided that they needed to do something about that. But like the TARP program, it's extraordinarily difficult to try and intervene in any of these markets directly. And despite spending roughly $250 billion, they had only, in the end, a marginal effect. So as I say, the last time I looked a few days ago, that Shanghai Composite was around 3,000. My own view is probably it'll drift down once everything gets back to normal and they stop these big buying programs to around 2.5. 100,000 until they put in these reforms. At some point, some people are going to make lots of money in the Chinese stock market, because when these reforms go in, if you can just get hold of some of that growth and some of these very successful firms, then there is a lot of money to be made. But that's, I think, still some way off. Let me stop there and turn it over to questions if people have any. Okay, that's good. Thanks.
Questions on the presentation on the stock market and the economy? And we can broaden the scope a bit if you feel like it. There are lots of things worth discussing in China. Yes, please. There's a microphone coming up.
You said there were many successful firms. Is that the case? And which businesses are these successful firms? And are they partly SOEs or not?
So obviously there's a huge range. China is a very big economy. So, but you know, if you look at a firm like Alibaba, Jack Ma, extremely successful, innovative firm. I guess it's worth 150 billion or something. So a major firm, and there are a number of other internet firms. If you look in the unlisted firms, though, there are many successful small and medium-sized enterprises. The state-owned enterprises, by and large, are not very successful. I mean, they've grown, but they don't make money. They invest a lot. So the steel companies, natural resources, all those kinds of firms, they've grown, but they haven't created wealth or created value. But they're a big part of the economy. But yes, there are a lot of rich people in China, and a lot of successful companies. But then the big problem is they're just not listed, most of them.
Johan Javius, SEB. These necessary reforms that you expect to come and that will be necessary for actually creating a better foundation for the stock market. Would you dare to put a time frame for when they can be implemented?
Well, as I say, I think most people expected that this would have started in the last year or so. The Shanghai Free Trade Zone was supposed to be the pilot program. It's on hold, but I think it really depends when the anti-corruption campaign stops growing and goes down, maybe even. And I think there's signs that that's beginning to happen, so I would expect these reforms, in the technical ones, may well happen in the next 2 or 3 years. The corporate governance, the opening up of the capital account, I would expect that would be a 5 to 10 year process. I mean, if you look at, China seems very keen to be part of the SDR, and the IMF wants them to make various changes. They're trying to do many of those. I think the really important one is opening up the capital account. Once that happens, China will be part of the global economy in a financial sense, in a way that it isn't now. And that's the really big one. That's still a few years off. But they're gradually pushing up the limits of the amount of money that can go into China by institutional investors, and the limits of money coming out. So it's happening, but it's slow at the moment.
Anders Rydin.
Anders Rydin from the Riksbank. You talked about listing, delisting, and corporate governance, but you also talked about investments being high. And if you have an economy where savings is as high as they are in China, then you would sort of, for that reason, expect return to capital to be low. Is it possible to say something about sort of the relative importance of these sort of structural inefficiencies relative to the sort of more normal explanation that if you have high savings, you get low return?
So China has a very distorted financial system. So it's true that in these companies that are here, in these diagrams, the returns are low. But there are, and this sort of related to the first question, there are sectors which are, in my view, are very large actually, particularly in terms of things like employment and so on, where returns are very high. So if you look in the shadow banking sector, so we have a number of papers on the shadow banking sector, but if you look at the kinds of rates of return that are paid there, they're more of the order of 15-20%. And since default in China is a fairly rare phenomenon, these are companies that can actually pay those. And you hear anecdotal stories about companies that will borrow money at 50 or 60% a year. So there is a part of China which is tremendously productive, but at the moment they don't get the funds. And this is the part of the inefficiency. So this reforms here is only a small part of what China needs to do. Really, the problem is that the banks are the real providers of funds to companies. But the banks mostly lend, they're mostly state-owned, and they mostly lend to state-owned enterprises. But that's not where the money is being made or the high returns are. What they need is to develop a financial system which gets money to these entrepreneurs, which are tremendously successful and get huge returns, and have them grow. And that's kind of slowed down. It used to be that when you're growing at 10 to 12%, there's so much in terms of retained earnings that you can finance internally. But now with the slowdown, that's much more difficult, and that's why other reforms that allow these entrepreneurs to get access to funds are so important.
Please.
Hi, Yan Chen from HCM. I have actually two questions. First one on the mainland Chinese stock market. So have you ever considered liquidity as a factor in terms of the performance in the poor performance in the market, since Chinese stock market is such a closed and still highly regulated liquidity pool? Second question on Hong Kong market. Since when we're talking about China, actually Hong Kong has been the only market that is investable for majority of the overseas investors. And in one of your slides, you also show that Hong Kong market's performance is not so much better than the mainland market. What do you think is the main reason for that? Thank you.
So first of all, on liquidity, as your question indicates, it is a different kind of market than Western markets. In particular, there aren't many institutional investors yet in China. They don't have large pension funds and large mutual funds and so on. So most of the investors are individual investors still. Now, in terms of liquidity, they have very high turnover. If I just go back to one of the early slides here, the turnover in Chinese stock market is actually very high. So it's difficult to if you look at these turnover numbers, they're very high for Shanghai and Shenzhen, because it's a very speculative, investor-driven market. So the shares are quite liquid in the sense that there's a lot of turnover. So that's the first point. But as I say, I think the real problem is just that the fundamentals aren't there. That's why it's so poorly performing. In terms of Hong Kong, I think the answer is the same thing, that mainland Chinese firms that are listed are just not performing that well. So, a big chunk of the Hong Kong market would be the banks, which are among the most valuable banks. ICBC was, for a long time after the crisis, the most valuable in terms of market cap bank in the world, and a large part of that is listed on Hong Kong. So I think a lot of the firms that are listed in Hong Kong that are on mainland China have this problem that they're again underperforming firms relative to the economy.
Henrik Torhammar, Aftonbladet. Wouldn't a change away from the SOEs towards more entrepreneurial, unlisted companies be a threat to the Chinese government?
So that's a very interesting question, and I think it's a threat both ways, because if they don't do that, then they won't grow as fast, and they have all these problems that they're not creating employment and so on. So. But as you say, I think this is the thing that they they politicians are very wary of, that they're not used to the notion that they turn it over to the market and the market makes these decisions. Whereas there's people like the head of the PBOC who believe strongly in the market. There are many of the people in the government who still, I think, are not signed on to that in quite the way that they need to be to break free and just allow the market to have wealth and ordinary people to become wealthy and so on. And it depends how you view the political situation there. I mean, I guess my own view is, if you look at Singapore, they've had the same party in government now for 60 years. It's not that much different than China. But we'll see. I think that's a very important factor.
Mats Nyman, Handelsbanken. I don't quite understand your basic presumption that just because the economy is growing quickly, the stock market should be performing well. There's a lot of studies over countries over time showing that countries that grow quicker do not have high returns on the stock market. In fact, there are some studies showing that the average return in countries which grow quickly economically, the stock market there's a negative correlation to stock market returns. Which really shouldn't be that surprising, I think, given that, well, in countries which grow quickly, there's also a lot more investments. As a shareholder, you get diluted, there's more creative destruction, etc. So there shouldn't be, theoretically, any automatic link between stock market returns and economic growth. There is, of course, a correlation between surprises and changes in economic growth and what's going on to the stock market. But that's a completely different thing, and that you don't see that in the stock market in China, which improved, could be driven, of course, by the fact that the GDP numbers are not representative of the true economy.
So I guess my sort of starting presumption is that if you just had the economy represented by identical firms, then it would be like the Gordon growth model, the C over or div over R minus G kind of model. And if G is high, prices should be high. The surprising thing is that the cash flows in most of these companies don't grow as fast, or most of the large companies don't grow as fast. Now, as I showed in the table, the correlations in many countries are quite low, but in many other countries they're high. So, I mean, if you were to take the equivalent number for the US, if you go back to the point where equivalent of 1992 for the US economy in terms of the growth, it's something like 1955, 1960. The S&P was at, so let me do the Dow. I think the Dow's easy one to remember. It's something like 1,000. I think most people would be surprised if the Dow was still at 1,000 today. But that's effectively what's happened in China. The Dow's by and large grown with, and the S&P have grown with the economy, and that's true in most Western economies, as the numbers showed. But what's happened in China, it just hasn't happened, and so as you say, there are lots of reasons you can explain that and so on. But by and large, I think most people would be surprised if the US or the UK or many European stock markets hadn't grown for the last 50 years, which is the roughly equivalent in growth terms. But as you say, there are studies which show that in many countries that doesn't happen.
Yes, Gustav Renman, AGCM. In your concluding remarks, you refer to explain the poor performance, you talk about tunneling and bad investment decisions. I think there's also another component to this, and that's the fact that many of these large SOEs like PetroChina, China Mobile, and so on, it's not really on the owner's agenda to have a high earnings growth. I mean, for PetroChina, the main task is to provide fuel to the economy rather than to maximize profits, and same thing with the power companies. So a large chunk of these companies don't really have the goal to maximize shareholder value. Your comment on that. And then another question regarding the base year for this study. You started in the year 2000. Would the outcome have been different had you started in, say, 2005, given the fact that we had a very large correction in the A-share market in China we had corrections in many of these markets, but I think we had extremely high valuations in 2000 in the mainland markets.
So let me, they're not maximizing profit. I certainly agree with that. I mean, they're not there. They're there to provide the services to the economy and provide employment and so on. But I think that's the sense when I talk about corporate governance. That's one of the big issues as to whether these companies are going to change and become profit maximizing or value creating, value maximization companies. And I think that's why the opening up of the capital account is so important, because if money's free to go out and seek higher returns, those kinds of companies are going to have problems raising capital. Now, it may be that the Chinese government decides for political reasons to divert money to them and so forth, but ultimately this problem is that you end up with inefficient investment if you run an economy that way. And we went through that in Europe in the 50s and 60s. It just doesn't work very well. And I think China has to make a fundamental decision as to whether or not they're going to do that, or whether they're going to rely on the market or they're going to rely on politicians or central planners to drive the economy. My own view is they want to keep growing, then they need to move towards a more profit maximizing culture, just because that's the way of getting high growth, by getting money to the firms which have got great projects, which I believe there are many of them if you look at the shadow banking system. So that's a political decision though, and we'll see how it plays out. With regard to your second question, clearly, I mean, one of the very interesting things is quite where you choose the starting points does matter. And actually one of the interesting things I've learned from this project is quite how important that is in terms of these things. I think 2000 probably doesn't make too much difference, but we should probably do some more sensitivity analysis to that. I mean, as I say, I think the basic point is that it hasn't grown. However one looks at it, you just haven't made much money in the Chinese stock market. Even if you bought at the trough and sold at the peak, you haven't done that well relative to many markets.
Okay, I don't see any more. I see one hand in the air. While you get for the micro, can I ask, this may be a stupid question, but investors have for a long period of time tried to invest in high growth countries, like the BRIC countries, and China has been one of them. And I guess then you want to have as liquid investment as possible, so the stock market would be a natural place to look for investing. And you've just given very good reasons to avoid investing in the on the exchange in the stock market in China. Is the pattern of it for sort of investments that international investors do different in China for this reason than in like the other BRIC countries or any sort of comparable countries? You've just given reasons why one maybe should expect it.
So there are still fairly extensive capital controls. So there's a limited amount of money that can go for portfolio investment into China at the moment. So that's why the Hong Kong market, as the question earlier indicated, is relatively important, because there you can go and invest and get mainline China exposure. You can also invest in ADRs and do as I said, they're a different kind of firm. They're much better, and they've done much better.
Or real estate to some extent, I guess.
So real estate, picking Beijing, Shanghai, it's done well, but in the long term. But again, it's difficult for outside investors to put money in. So there's a lot of FDI, particularly at the beginning of the growth miracle. FDI played a very important role. Today it's relatively small to the compared to the amount invested. So there are barriers, and again, this is why the capital account being opened up is so important, because then those barriers will go away, and we will see. you know, if it becomes part of the MSCI index, then there's going to be huge flows into China from that. I think there'll also be huge flows out, and the big problem with the exchange rate is we don't know what the balance of that is. People have done studies, the Hong Kong Monetary Authority's done studies based on what happened in other countries when they opened up the capital account. My own view is that China's just, it's a very difficult one to call, and we may well see the RMB strengthen, we may well see it fall, and that's a very difficult one to call.
Yeah, thank you. I just like to follow his question. I used to listen to a private company from Minsheng Group, or Minsheng Bank is a private one. And he was very proud that the company only is a alumni. They have alumni company and only hire 460 people. And they have the 200% or more profit, and compare with the state-owned SOE company, which hire 10,000 people. Of course, the SOE doesn't make that much profit. But in terms of CSR, you say, I see we can't just say, how can I say, maybe must find a middle way to choose, because SOE hire more people, and then it's better for the social stability and welfare of the employees, maybe. How do you comment on this?
So I think, you know, this is obviously a very important question. If you look at Japan, they've clearly, although they have American-style laws because they were put in place after the Second World War, where the shareholders are the owners and get to direct things, Japanese managers don't really take much notice of that. So they basically run a world where they care a great deal about employment. They're extremely unwilling to fire people. So one of the interesting facts about the crisis is that the country which had the biggest GDP drop was Japan. They had a 10% drop in GDP after the Lehman default, but unemployment hardly went up at all. So somehow these firms absorbed this huge drop in business without firing people, and that's great in the short run. Now, Japan also illustrates the long-run problem of that, which is they don't grow very much. What they've done is put huge burdens on young people because they're all hired, not all, but many of them are hired on temporary contracts, and they have no security at all. So there's a group that has tremendous security, and then there's another group that doesn't have much. And that's happened in much of Europe too, where you have strong protection of labor. So I think, you know, you need to get a balance. We probably don't, you know, in the US, as soon as anything bad goes wrong, people get fired. And we had this huge drop in participation rates as a result of that in the US. So I think you need a balance. But I guess in the long run, you have to provide funds to companies that are doing new things and growing and improving the economy. Otherwise, you get a stagnant world without much growth. And a good example of that, I think, is India. India very much took a perception of we've got to protect employment and so on, and they grew at 3.5% for 30 years after independence. It wasn't until 1991 that they started growing quickly, and now they're growing 6-7%, which and they probably could grow much faster than that. But it's a key, obviously it's what much of the political discourse in Europe's been about for the last 30 or 40 years.
Johan?
Johan Schick from Dagens Nyheter. You talked rather briefly about the recent events, the bubble phenomena and the following slump. And I would ask you to expand a little on that, especially as it brought so much attention then to the weaknesses in the Chinese economy as a whole, even if, as you say, is a weak correlation between the stock market and the economic performance. Still, it has been an eye-opener for many people.
Yeah, I mean, I think There's a presumption in much of the world that China is just this other country, and that we have these universal laws of economics, and certainly some of those apply. But I think it is very different in terms of the institutions still, and that's not well understood outside. So the market, first of all, went up incredibly. So if you look at the price movements, it did extraordinarily well. As I said earlier to one of question, I think that was liquidity driven, that money came out of going into property and went into the stock market, and we had this huge run up in prices. People then began to say, well, this isn't sustainable, and there are lots of indicators like margin lending and so on, which were very high. So a lot of it was borrowed money. And it wasn't sustainable. And then when it was day after day of these massive falls, the government got very, very scared. And so they stopped trading. I mean, at some point, a very large proportion of the stocks were simply not trading. They closed. So, but even so, the prices kept going down. Then they stepped in and started telling the pension funds and so on, the investors they controlled, to buy, which they did, and that stopped it temporarily. But then it started going down once people realized, now perhaps we can get out. So despite spending these enormous amounts of money, they weren't able to control the market. And I think that came as news to the political class, that they couldn't do that. For the outside world, China is, as I say, I think there's not much following of that. There's not much realization of quite how successful they've been, and quite how likely it is that they're going to keep growing. As I say, at the moment, they're growing by government fiat, I would say, more than by profit-driven growth. But as I said in my answer to Anders, my own view is that there are all these tremendous projects out there. I mean, in terms of GDP per capita, they're a quarter of what the US is. So there's still huge scope for growth, and technically, they're great. I mean, they have people in space and all of those kinds of things. They have defense industry, which, if you think about what they're doing in terms of missiles, anti-carrier missiles and so on, they have great technical capabilities. If you think of cyberspace, all the hacking and so on, this indicates they have wonderful technology. And it's not surprising. You go to, I teach at Imperial now. You walk around the campus, a huge proportion of the students are Chinese. And the same was true in the US. There's not many domestic, I don't know if it's true in Sweden, but certainly there are not many British or American students doing engineering. They're doing finance and things like that. So China has tremendous growth. And if you look at, obviously it's a big country, so it's a little bit different. But Taiwan, 1950, Taiwan was at African levels. It had the same GDP per capita as Ghana. Today, it's about the same in GDP per capita as Germany. It's overtaken France and the UK several years ago. And so if Taiwan can do it, Korea's basically the same. They were at African levels, they're now at Southern European levels, and they're still growing very fast. So I think there's tremendous growth potential in China still. But they need to, they can't do it by central planning anymore is my view.
Please.
Yes, Yan Chen again. I think when you look at the market as a whole, it's of course very much dominated still by the SOEs. But I think the trend is also changing. Do we know how much of the market cap is dominated by SOEs, or do you think the trend is coming down? Have you looked at if you separate the SOEs and the private companies, what would the returns look like?
Yes, so that's what some of the early tables were doing. So table 3 had some of those breakdowns, and there are more in the paper. So I think we're going to post the paper on the website, and you can look at some of the details. But yeah, I mean, the big trend in the Chinese economy is moving away from SOEs in terms of proportion of GDP to private firms. And what we need to do is get these private firms listed now, and that's once that happens, then we can get a more normal kind of economy, in my view.
Okay, maybe one last. Recently there was an IMF financial stability report where they voiced concerns over the degree of leverage in emerging markets, and I think including China, and that this could pose a stability problem to the world. Is that a concern you would share?
So debt has been building up very significantly in China. A lot of the debt has been taken on essentially by entities set up by local governments. And one of the concerns is that if you include that, China's up to about 80% of GDP, 90% in terms of government debt. Now the central government doesn't have that much debt, that's about 30% of GDP. But one of the big issues that they face is reform of local government finance, because at the moment the main source of funds in many places is selling land, and that's not a good long-term solution. So they either need to have taxing power or they need to have block grants from the central government, and they have to decide what they're going to do about that and how they're going to service this debt. My own view is that there probably isn't a problem because the government still controls so much. So they have huge amounts of resources and they can control the debt. So I don't expect there to be defaults anytime soon, but there may be a bumpy ride and questions about how they deal, particularly with this local government debt.
Okay, we have run out of time. No more questions. In that case, Franklin, Alan, thank you very much for coming. Thank you.
Thank you.